In 1612, the Dutch East India Company occupied a unique position as the world's first megacorporation, but it was approaching a mandatory 10-year deadline that legally required the entire enterprise to cease operations. Outwardly, the VOC projected absolute power. They had deployed tens of thousands of mercenaries and built heavy stone fortresses across Asia to lock down a highly lucrative spice monopoly. However, the binding terms of their 1602 charter demanded a total liquidation of the company by its 10th anniversary, with every guilder of capital returned to the original investors. Meeting this obligation was a physical impossibility. The company had spent nearly all its initial cash outfitting warships and paying soldiers to secure those trade routes. Their capital was sunk into the ground in Asia, leaving their vaults in Amsterdam virtually empty. This lack of liquid cash created a lethal financial contradiction. The world's largest commercial empire was technically insolvent at the very moment it was legally required to pay everyone back. Fearing a total collapse, the directors made a unilateral move in 1612. They flatly refused to liquidate, effectively declaring the company's capital to be permanent. To pacify the furious shareholders, the board promised a massive 162.5% dividend payout to be distributed in installments through the year 1616. By March 1613, the crisis reached a breaking point. The VOC needed to launch a new 12-ship fleet to fend off English competitors, but outfitting those ships required funds the company simply did not have. They were trapped. They had zero liquid reserves, a massive dividend debt looming, with directors personally liable for loans. They couldn't borrow from banks without risking their family fortunes. The math suggested a final outcome. If the 1613 fleet failed to return a staggering profit, the entire Dutch East India Company would mathematically cease to exist. On March 1, 1613, the directors drafted a specific contractual mechanism designed to bridge this liquidity gap. Standard marine insurance already existed, but it was limited to protecting physical ships from sinking or being captured by pirates. This new contract moved the goalposts. It insured the revenue itself, guaranteeing that the 1613 fleet would generate 3.2 million guilders by August 1616, regardless of what happened to the actual cargo. Curiously, the backers of this policy weren't external banks. The VOC sold the insurance to its own shareholders and directors. In exchange for taking on this liability, the company paid these insiders a 5% premium directly from the corporate treasury. At a glance, this arrangement resembles an internal siphoning of funds, a way for directors to move company cash into their own pockets while the treasury was under pressure. However, the directors were taking on a disproportionate level of personal risk. By underwriting the policy themselves, they were pledging their own wealth to save the company's balance sheet. Their strategy aligns with what modern economists recognize as corporate risk management. The board knew that if 1616 revenues were to fall short, the company would be unable to pay its promised dividends or fund future fleets. The 3.2 million guilder floor provided a mathematical safety net. If returns were too low, the underwriters were legally bound to inject their own cash into the VOC, covering the deficit and keeping the business running. The contract prioritized the continuity of the monopoly, ensuring the company had the liquid cash to survive even if its physical assets were lost at sea. When 1616 arrived, revenings likely fell below the target. By the terms of the contract, the underwriters should have paid out a massive sum to the VOC, but the company reached a stalemate. The wealthy shareholders who owed the company insurance money were the same people to whom the company still owed those massive delayed dividends. Neither side could easily pay the other. This gridlock forced the directors to abandon the insurance model and seek a permanent structural change to how the company was financed. In 1617, the directors agreed to assume joint liability for all company debts. This shared risk gave lenders enough confidence to finally open the floodgates of Amsterdam's credit markets. This influx of capital put the VOC's operations in Asia on a permanent footing, allowing Jan Pieter's own Koon to solidify the monopoly through military force. By 1623, this evolution was complete, as the company officially formalized limited liability for its directors. The modern corporate playbook emerged from these survival tactics. forged by merchants who solved a lethal cash flow crisis through piecemeal engineering.